We'll continue our discussion on dividend discount model in that we were discussing about Gordon growth model. So we mentioned that dividend discount model is nothing but discounting the future dividend payouts, which is dividend in the future, and plus the last price. This price basically represents when you sell the stock at that point in time. What will be the price this discounted by? The cost of equity, which represents a multi-dividend discount model, in that we mentioned that arriving at these dividends is a very, very difficult task for any analyst. So that information is usually not available. The reason is these expectations of the dividends payouts are in future. On those numbers, you know what will be the future profitability and how much even after profitability, the company would be willing to pay out depending upon their investment plans or investment. Investing back in the business or paying it to the shareholders is something which is very much policy related. That information for an analyst becomes very, very difficult to arrive at. So what we can do as an alternate is apply a Gordon growth model here. Gordon growth model is basically it defines value as dividend paid in the current, multiplied by 1 plus the growth rate of dividend divided by R is the cost of equity minus the growth. So basically this defines a formula for Gordon growth model, which is pretty much arrived from this only through a calculation. But let's see this formula in action now. So, in this question, it's mentioned that stock XYZ paid a dividend of $3 for the year 2011, and its investors require a rate of return of 10% on equity. The dividends are expected to grow at a constant rate of 7% in perpetuity. Calculate the value of XYZ stock, as well as how much stock value is due to dividend growth. So in this, what we need to do is, first of all, we need to write down what all information we are given. So we see here that we are given D0 as $3. And we're also given that the rate of return on equity, that is R, is 10%. We are also given that the growth in the dividend is at 7%. And now it says that you may need to calculate the stock value of XYZ, how much stock is due to dividend growth. Our formula is basically D0 multiplied by 1 plus G divided by RG. So this is the formula for Gordon growth model. So in this, we need to just apply this formula, and accordingly, we'll be able to arrive at our numbers. So we are multiplying 3, which is our current dividend, 1 plus 7%, which is our growth. So basically, this 3.21 will represent D1. D1 is the dividend which is expected to be paid out next year. And as you could remember, you know this is based on our assumption that dividend is expected to be paid out the next year. So now we need to just divide this by the spread to arrive at V0. That is the value of stock, R, which is 10% to 7. And this will give us $17. So in this, I need to mention one more thing that we are dividing. 3.21 by R, G, and this also brings back our another assumption of Gordon growth model, that the spread of cost of equity and growth has to be positive. So basically what we are trying to say is cost of equity has to be more than growth. In case this cost of equity is not more than growth, then it will not be a meaningful result. Let's assume that the rate is 7% and growth is 10%, in which we are saying that cost of equity or the cost of the rate of return we are saying is less than the growth. Let's try and solve what will be our answer. I'm just reversing the numbers here. So 7 minus 10. So you see it's minus 100%, and stock value cannot be in minus. It cannot be negative. So what we are basically saying here is that cost of equity or the rate of return has to be more than the growth rate, and this is our basic assumption of dividend. You know the Gordon growth model, and we should really be particular about this assumption in case we see any scenario where we are seeing cost of equity is actually less than growth, then we cannot apply Gordon growth model. With this, we complete the Gordon growth model. Let's try and recap what we have done. In the Gordon growth model, we have simply applied this formula. So what it really simplifies is in the DDM, what we were expected to arrive at was future dividends. Now we need to arrive at dividend expected in 1 year, after 2 years, 3 years, and an nth value. So that level of information is not expected for GGM. That is Gordon growth model. In this, what we need to do is basically we have our current dividends. We need to just apply the growth rate on dividend. That is just to make an expectation what will be the dividend payout next year. So we take this year's dividend multiplied by 1 plus growth. We do arrive at what will be the next year's dividend, and we divide it by R, G, where R is the cost of equity and G is growth in dividend, and we need to make sure that R, G is positive number. As I mentioned, that in case this is a negative number, that is cost of equity is less than growth, then our Gordon growth model will not work. Let's move on to our next level of discussion on the dividend discount model.